Tech Lifestyle here, back with another video. Right, oops, this one's on from CNBC, and this guy here, Corey Kasama, I think his name is. I can't say his name properly, but he is going to be talking about the 10-year Treasury yield, how he thinks that this whole system is broken, and this could be very devastating for pension funds going forward. Guys, I think we're in a situation where the financial collapse is likely to happen, but they're sustaining it with using war as a way of printing money to keep this thing afloat. Anyway, let me play you the video.
Above 5% for the first time in 16 years. Let's bring in Komal Sri-Kumar, president of Sri-Kumar Global Strategies.
Kumar, yeah.
And get his view on what he thinks is going on. Sri, and I know you watch, and we've been talking, we've used terms like untethered and unmoored. And I think that's what you want to focus on, because there could be some, I guess, somewhat disturbing outcomes if the Fed has lost control of its ability to set long rates. We've never believed they could set long rates, but for a while it looked like it was all orderly. They haven't raised rates in a while, and we've had, 80 basis points, 70 basis point increase in the 10-year. That could be troubling, and it is to you.
Absolutely. I put out a report on Saturday, Joe, saying precisely that for the first time, you have Jerome Powell, who has never been doubtful as to what he did, even though he has been sometimes wrong on expectations of inflation and interest rates, finally said in his Economic Club of New York talk, as well as in the Q&A session, that he did not know what is causing the higher bond yields. He attributes that to term premiums. The term premiums are not measurable. And therefore, essentially, the Fed chairman comes down to saying, I don't know what it is. And when he said that, I said, we are in completely uncharted territory. Things are going to get worse next week because of the fact that the Fed is totally out of control and they don't know what to do next. So you are absolutely correct. I think unintended consequences are going to happen. I've been saying that on your show for quite some time, whether it be a huge bank failure, whether it should be pension funds losing a lot of money, commercial real estate suddenly worsening, or a CLO, commercial loan market, and levered obligations having difficulty, somewhere things are going to break. And rather than expecting 3 to 6 months, I'm going to say within the next 4 or 5 weeks.
Sri, individuals that are more sympathetic to Chairman Powell's plight have actually said that this was totally Chair Powell's doing and exactly what he wanted, and that when he said higher for longer in recent appearances, that he said it better, or said it in that he actually stimulated yields to go higher, and it was exactly what he wanted, and he kept saying higher for longer, and that he orchestrated deliberately this move up to 5%. And I don't know, we've been saying higher for longer for 7, 8, 9 months, and suddenly we're almost not inverted anymore because of what's happened on the long end. Sri?
There are 2 points in response to your the issues you raised, Joe. They are very relevant. First of all, yes, he wanted inflation, the interest rate to be higher, the yield to be higher, but I don't think he wanted it to go well over 5% as it's done again today, and in that rapid fashion as he has done it. Second, if he is looking for yields to stay that high and to go up that rapidly, if that was his intention, he also must be intending to create a train wreck, meaning that he is going to cause something to crash. And if you tell me that is part of his intentions, then he's right, doing exactly what he wanted to do. But that's not, I'm sure that's not what the chairman wants. What he wants is a mild increase in the unemployment rate. He wants the job opening rate to come down. He wants the inflation rate closer to the target, but otherwise the economy moving smoothly. But that's not what he's going to get. There is no via media between too much excess and crashing if you follow a policy of this kind when the bond yields, you said they are not controlled by the Fed. That is true. But today he has totally lost control of them and not able to influence them, and that is a lot more serious.
Yeah, I don't know what breaks, and we could do a David Letterman top 10 list. He used to do I guess he was at one point a late night host of a show.
I remember that.
Now he hasn't shaved since he left, I don't think. But but the top 10 list, though, could be commercial real estate. It could be a lot of it. It could be another bank. It could be a lot of different things. But it's scary. But for whatever it is, and there's no guarantee that you'll be right on this, but you could be. But you think that shifts the Fed to easing quicker than anyone anticipates at this point? When do you expect that? So you think within 6 months we could be back on an easing path or a rate cutting path, Sri, within 6 months?
Yeah, Joe, just look at last March to give yourself an indication. We had 3 small regional banks which failed. And immediately quantitative tightening ended and quantitative easing was put in place. We took the Fed assets back to November of 2022. We set it back by 5 months. What I'm saying is if that incident could do that, anything like a bigger crash taking place in the next 2 to 3 months is going to completely reverse monetary policy in terms of both interest rates and quantitative tightening. And yes, within the time period that you mentioned is clearly when I think it will happen. 2024 is going to be a year of lower interest rates and clearly a much more easier Fed than we have seen so far.
I don't know whether that's good or bad. I mean, we have had, the sort of the specter, the possible, Rick has mentioned some things that if you look at a chart, much higher rates could be in the cards than what we're seeing. At least in this case, it sounds like maybe where there's going to be some turbulence on the way, but it would keep us from getting up to, 7, 8, 9%.
Exactly.
Anytime. That won't happen, you don't think, in the next 5 years even.
That's exactly what I'm saying. That yes, you may want higher yield to restrain the economy, but you cannot do that without wrecking something, without breaking something within the system.
Because people got too used to that. We were there. There's people 30 and 40 years old. They have no idea what that rates can go above like 5%.
So, guys, you're hearing it. The Fed has lost control. The situation in the world is dire when it comes down to, all the geographical tensions that are taking place. They have to bring more money for the war, unfortunately, and that's clearly going to have an impact on your future, my future, your children's future, your grandchildren's future. However, there is a silver lining, I would say, and I think it's digital assets. I believe we will be going into that realm extremely sooner than we think. Coming at the end of this month, November, there is the ISO 222 messaging standard being rolled out. It may be delayed slightly, but most banks have to do this by 2024, I believe, is the cut-off date, but they're starting in November, so it's going to take a bit of time to roll these things out. So guys, listen, we also have the digital ID thing, and that could potentially be scary, and I want to play you a video about that actually. I want to get that now before and then I'm going to cap this off. Okay, so hold on. From this lady who was going to be talking about the digital ID hostage situation, Justin Trudeau and the healthcare system, how the digital ID can cut you off on so many different things. It's something that people need to be aware of because it could happen. I'm not saying it will, but it could. It's something that people should really be thinking about seriously.
Podcast regarding the digital IDs. Yesterday in Canada, Justin Trudeau met with all of our provincial premiers and basically told them that we will not be able to get funding for our healthcare unless the premiers agree to the digital IDs. I will show all the proof. Now, those of you who think that digital IDs are great, they are not. Let me show you what these digital IDs will actually entail when it comes to control. Here's an overview basically of everything that will be included in the digital IDs. This can be found on the WEF website and also on all of the provincial and government websites. You will have healthcare. You will not be able to access any healthcare without this digital ID. Financial system. You will actually not even be able to carry out bank accounts or carry out anything online regarding financial transactions. Food and sustainability. This says for farmers and consumers, you will not be able to get into stores. You will not be able to even sell anywhere. Once they have this system in place, this is where the digital currency will come in. Travel and mobility. We saw that with the Arrive scam app. Humanitarian responses, which is basically just garbage. It's in case something happens, they will be able to track and find you, including if you don't want anything injected in your body. E-commerce. You will not be able to shop online. Then you have social media platforms. You will literally need this ID in order to get TikTok, Twitter, or Facebook. No more fake accounts. You have e-government. So if you want your taxes done, any sort of benefits from there, you will need this. Then it gets even scarier. Telecommunications. You will not be able to actually get an internet provider without this digital ID, and they will be able to track you. And then up there you have smart cities, and we all know what those are. Those of you who think I'm lying, here's the federal condition in order for us to access our money, our tax money. This is basically a hostage situation of our tax money. And what you will see is instigators, government instigators under Twitter, under Justin Trudeau, that basically say we need to push our provincial governments to, get the money so that we can spend it better. No, we don't. We actually need to call our provincial governments right now, today and tomorrow, and every single day until they scrap this digital ID. They cannot pass this without our approval. So I need everybody in Canada to call your provincial governments and literally tell them that this is not going to happen. If we need to privatize, if we need to somehow get into a different system of healthcare, we need to do that. As for everyone in the United States, you're kind of lucky because your healthcare is privatized. There's also a lot more internet providers, some that will not go along with it because of capitalism. So your money is actually speaking a lot louder in the United States. But Canada, this is coming down the pipeline, and it's coming down the pipeline fast.
This is not just going to happen in Canada. This is something that the governments across the board are rolling out. And this is the UK government website. Next steps, plans to grow use of digital identities revealed. Plans reveal how data can be shared between organisations so they can run smoother and users can access services more easily. The government has today published the second version of its digital ID trust framework, which part of plans to make it faster, easier for people to verify themselves using modern technology through a process as trusted as using driver's license or passports. The latest draft rules of the road for governing the future use of digital IDs follow the publication of the first version, the trust framework, on February 2021. They have not just come out with this, right? Think about what happened in 2020, and all of a sudden we have this in 2021. This has been planned for a long time, guys, okay? So what I'm gonna say is wake up, smell the coffee, maybe look at assets like gold, silver, and other, maybe Bitcoin could be one of those ones because it's decentralized, and you could possibly look at XRP, that's decentralized, and tokens that have utility, that you could be in front of 99% of the population. That's what I'm trying to say. Anyway, digital lifestyle out. You take care, like and subscribe.